can it be that all these professional financial advisors recommend 0% physical gold allocation to their clients? It is just incredulous that they can be acting in their clients' best interests if they're aware of this history and still going down that path. I submit to you, the only wrong allocation is 0%. You know, when you look in scripture, it's very comforting to see that no matter what the pestilence or plague was that God was sending to the world, he protected his own who tried to honor him, who tried to follow his commands. And so I think we're going to see in the future associations and the members of entities like the St. Joseph Guild having a very different and more comfortable, more prosperous future than those who associate and do business with entities that really are an affront to the Lord. So I think you'll find that the relationships you cultivate through an association like the Guild turn out to be meaningful to you as we progress in this biblical chapter of history. And my thanks to each of you as well for attending, whether online or in person, for taking the time to explore this. And I'm grateful for the chance to cast our nets into deep water together, because often I believe from my experiences traveling around the country, investors just hear little sound bites from advisors and they take that as bedrock truth. They don't dig into it. And as a result, I think they're not as well informed as they may believe that they are. So we were glad to get one response from a financial advisor that Kevin just read as to why investors shouldn't bother to have any gold. And I always welcome the opportunity to do that, because if you're not a professional investor and you hear two arguments, you can just get lost in whoever speaks last and not really understand it. But when you have two professional investors who feel strongly in an opposite direction about how you should proceed, it usually allows the listener, the investor, to cultivate a much deeper understanding of reality. So we're going to address the points that that advisor brought up specifically here, and we're going to be giving you data. Finance is not about opinion, and finance should not be complicated. Anyone who makes finance complicated either doesn't understand it themselves, or they're trying to keep you subservient to them or needing them for their own financial gain. Finance is very simple, and gold is also very simple. Before we delve into that, the one point that Kevin brought up from my background was that I worked at Lehman Brothers. So let me take that as a sign to just give you a moment's understanding as to how I came into this position. So I didn't grow up as a gold bull at all. I was fully focused on and enjoyed stocks from the time I was a boy. I remember growing up sitting on my dad's lap watching Louis Kaiser with Wall Street Week, which some of you may have seen on Friday nights before there was cable TV. I went to Wharton, studied finance. I worked on Wall Street. I worked in institutional equities. I wrote my own research. And I was fully focused on stocks, never had an interest in gold. The last company that did recruit me while I was on Wall Street was Lehman Brothers. So when I went there in 2000, the company had a 100-year history almost at that point, incredible track record. And it never dawned on me that what would unfold would come to pass. So in 2007, the stock of Lehman Brothers, I believe at the time, was hitting maybe $120 a share. And rumors began to, I shouldn't say rumors, stories began to percolate in the press, right? We had Bear Stearns go down, in the fall of 2008 that Lehman Brothers was going to be in trouble too. Now, any of our pets should have been able to look at the balance sheet of Lehman Brothers and know there was a problem coming, right? It was that obvious. When you look at the size of the debt versus the equity, it should have been apparent to everyone that whenever there was a speed bump, it was going to be very problematic for Lehman Brothers. But what Lehman did that was so insidious, and I think is practiced by many financial firms today in America, is they forced us to take our compensation in company stock. And if we left Lehman, we would give that up and it wouldn't vest for 5 years. So depending on your rank, you were reinvesting a third of your income into Lehman stock. And the idea of walking away from that just became so big in the minds of us as employees, we just started rationalizing with ourselves. We said, oh, the company's been around 100 years. We have the #1 stock franchise on Wall Street, literally. We have the #1 fixed income franchise on Wall Street, literally, as voted by institutional investor. If Bear Stearns is bought out for $10 a share, we're going to be a franchise of tremendous value. So we just justified in our minds the behavior that we were going forward with, even though it was clearly not right. So fast forward to September 15th, 2008, and all of our savings, the thousands of employees at Lehman Brothers, went to zero overnight. And it was a very painful lesson, as you can imagine, when you have to go home to your family and you've been working hard and so much of what you saved goes to zero overnight. And it's difficult to examine yourself at that moment and realize, I should have seen this coming. I should have protected my family differently. So Barclays bought Lehman Brothers, and I was given a position with more authority than I had ever had at that time. But as I had this major scar called Lehman Brothers, I started to realize if something like this happens again, where I start taking compensation in company stock of an entity that has lots of debts and it goes bankrupt again, I'm not going to be able to forgive myself for doing this to my family twice. You know that old saying, fool me once, shame on you, fool me twice, shame on me. So I had begun buying gold. And the reason was, as Lehman went down, all that pain hit. The question that then leaped to the forefront of everyone's consciousness at Lehman was, what can I invest in that is safe, that will protect my family? Not that's going to be a 10x return if everything goes right. For some portion of my wealth, what can I invest in that will preserve my wealth? Is there anything out there that does an above average job, that 51% of the time works? And when investors really look into that question, what leaps off the page is gold. You can go back to ancient Greece, and the value of gold has sustained its owners, has preserved purchasing power literally for thousands of years. That's a beautiful thing to be able to think about when you put your head on your pillow at night, right? Stock market today is near record valuations. Bond markets aren't far from where we just were at record valuations. Real estate near record valuations. Everything is rich. And I'm sure you all know when you start out paying for an asset and it's a very expensive valuation when you begin, the likelihood that you're going to get a good return down the road diminishes greatly, right? If it's very expensive when you invest, you just are betting it's going to get even more expensive, or there's going to be such phenomenal success that it compresses the multiple. That has not been a high probability bet in time. However, again, finance is about the numbers, it's about the data. How about the probability that if you put a portion of your wealth in gold, that portion of your balance sheet is going to be safe? Doesn't that have appeal to know that if you think you want 85% of your wealth gunning for a home run, fine. If that's what you decide is best for you at this point in your life. But do you really want 100% of your wealth gunning for that with all the risks? Or do you think you should have something that's defensive so that if you're hit by a bus, you know your spouse, your children, your heirs, they're protected? Now, we've had a couple of things happen recently as well that I believe should be saying to investors the urgency of this topic is really off the charts. Because up to now, going back to our grandparents' generation, they could take money and they could put it in the bank and it would be safe. And the history for that, which most of us don't realize, is also tied to gold. So if you read the Constitution of the United States, our founders were so brilliant what they set up in this country, this holy experiment, as they called it. The Constitution literally says the only legal money in this country will be gold and silver. And the founders felt so strongly about that that they actually created a death penalty in the United States. And the first and only crime that they attached the death penalty to was if anyone should try and make anything other than gold and silver our legal money, quote, they shall suffer death, unquote. So you have to ask yourself, what are the founders looking at that they didn't attach murder or some other heinous crime to death penalty, but they attached leading the nation away from gold and silver as money was so heinous that it would carry the death penalty. Well, what they were looking at, because they were great historians themselves, as they studied civilization for thousands of years, they saw every time a country has a currency that is backed by nothing, that currency goes to zero and the citizens are crushed financially every time. On the flip side, again, going back to ancient Greece, we can show how that gold preserved itself so that today it has the same purchasing power as it did then. A remarkable and unique achievement in finance with that kind of duration. So our grandfathers were still the beneficiaries of that. When they put money in the bank, they could convert that money into gold or silver. They literally would give paper to the bank and the bank would give them gold. In 1934, FDR did a horrible thing. He shut the banks down and he confiscated the Americans' wealth, the Americans' gold. And he did that to push in his own spending plans. He knew better. He knew what would be best for his agenda and apparently, by his words, for America. Obviously, it was not. He paid the American citizens in dollar cash for their gold. And when the world realized that the United States had broken this beautiful constitutional mandate where gold was interchangeable with paper money, the paper dollars were devalued by 70%. So imagine you're a citizen, you just saved in paper dollars and you just got crushed down 70%. It became worse in 1971 when Richard Nixon took nations off of the gold standard. Up until 1971, if you were in a foreign country, you could submit dollars and take our gold back because it was still gold backed at the national level. Nixon looked into the cameras on August the 15th, 1971, told the American people that the dollar was no longer backed by gold, but then looked into the camera and told America a bold-faced lie that he knew was a lie. And he said, your dollar will still be worth just as much tomorrow as it is today in 1971. That has been an abomination. The dollar has lost almost 90% of its value since that time. Meanwhile, gold is up over 50x. So it's not to say investors should have sold everything and bought gold, or sold all of their dollars and bought only gold. But it's to say that realize there are two primary functions to money. One is convenience, so you go to the supermarket and you can buy whatever you want. But the second primary function of money is to preserve wealth. It's not a risk asset like equities that could go to zero. It's just a safe place, a safe harbor for you and your capital. Since the unbacked gold, that has not been the case. The dollar has been a disaster. So the plan that our ancestors knew And that is, you can put X amount of your wealth into a risky asset that has lots of upside potential but has risk. And then the plan of your conservative allocation would be in the dollar, held solid for years, held solid for centuries while we lived on the founder's plan. But since we've broken that mandate, putting money in the bank has not been a good safe haven for us. What has happened is the purchasing power, as you know, has been obliterated. So I submit to you today, what do you think is going to happen? Do you think the dollar is now going to begin stabilizing and that the purchasing power of the money you earn and keep in greenbacks is going to be constant? Why would you think that? Our debts have never been worse. The debts of our country are unpayable without devaluing the dollar. What do I mean? As you may know, we have $30 trillion in debt. We have 200 trillion if you include what are called our unfunded liabilities, our promises for Social Security, our promises for Medicare. 200 trillion. When you look at our revenue base as a country of a few trillion, you just can never pay that back. Even if you don't have any expenses as a country, you cannot pay that back unless you make the value of the dollar so cheap that it's essentially worthless. Do you want to be saving in an asset that has that kind of fundamentals and that kind of an outlook, knowing the probability says that an unbacked currency like the dollar has never worked? So what we're submitting to investors is that the urgency is huge. So this month alone, if you didn't see it, there has been this significant trend where the central banks, who are the most informed entities about our currencies globally, have been aggressively reducing their allocation to US dollars. At the same time, they have been building their allocation to gold. So these very politically plugged in entities are voting with their wallets, sell dollars, buy gold. 2022 was an all-time record, I should say in the modern era, as long as we have records, was a record in terms of how much gold central banks around the world bought for themselves. What is that telling you? In 2023, that record pace is accelerated further as these nations see what the US is doing with our debts, with our policies, and they're walking away from us. This month alone, I mean, we could talk for so long about the individual stories, but just consider this month alone. One of our key historic allies in the Middle East, the United Arab Emirates, just bought a record 75 tons of gold. They wanted to diversify their balance sheet, get away from dollars. They bought gold, but they chose to snub the US dollar, to snub America, to snub our administration. And they chose to buy it from a country we forbid, with some audacity, others to trade with. We forbid them to trade with Russia. And they said, no problem. We don't care what your policies are, America. We're buying this gold from Russia. So what do you think that says about these entities and their outlook for dollars and for what nations are going to have sway in the world moving forward? Additionally, just in the last 24 hours, literally the last 24 hours, hit the tape that Janet Yellen, who I think you all know, said the dollar is going to be losing its reserve status. She's telling you, America, the money you have saved in the bank is going to be losing its global appeal. Think about this. What is gold? It's simple. Gold is money. Our Constitution says it. The history books back to ancient Greece say it. The central banks say it. The former chairman of the Fed said, gold is the world's premier currency and none can compete with it, including the dollar. That's what our central bank president said. Gold is money and nothing else can compete with it. And now you have Secretary Yellen saying, yes, the dollar is going to be losing its value as a reserve currency. That is like inside information for us, right? They're telling us what's going to happen. And yet today, Americans are so overweighted to the dollar in their portfolios. It's potentially setting up for a tragedy because this is so easy to protect yourself from. I feel like I was so blessed now to have been run over at Lehman Brothers, run over. Why do I say that? Because Lehman Brothers was really a microcosm of America. Our debts were too big. It was going to definitely impair our currency, but I had the choice to get out. And instead, I just said, I hope everything will be okay. You do not want to have to do what I did and look your family in the eye and say, you made foolish decisions, especially when it was so easy to protect yourself. Now, Kevin also mentioned industry here. I despise the ads in my industry. I think the gold industry has the worst ads on television. It sells Armageddon, gloom and doom, and fear. That is not gold. Gold is about a brighter tomorrow. We've had thousands of years of human history. Armageddon's never happened. I am not betting on Armageddon. But what I am betting on is we have 700 case studies, literally 700 case studies, where these nations issued a currency to their citizens. They didn't back up anything. All 700, the currencies became worthless. I am betting on those probabilities manifesting themselves again. Now, I'm not selling everything and only buying gold and bunkering down, but I am saying I want to position a portion of my wealth in this asset that has been so safe. And because when debts become unpayable, wealth historically transitions to gold. So we have some slides in here we'll talk about relative to other historic currencies that were the sole reserve, like the dollar is today. And you'll see that the decision to just do nothing, like to bury your head in the sand because it's difficult to think about, has literally been tragic for families for generations. So with that overview, let's turn, actually, I almost forgot. So we talked about the news in the last 24 hours. Yellen, first thing, saying again, your dollars are going to be worth less. Not worthless, she said, but worth less is a loose reserve currency. Now, having said that, let me also tell you a very famous investor that's dear to many in the Midwest, where you are primarily based, Charlie Munger, partner with Warren Buffett, conducted a video interview, and he said, our working hypothesis is that the dollar will be worthless, not worth less, worthless, worth zero. That is their working hypothesis. Why? I know why. They see the data. They see our debts. They know what's going to happen. Yet that entity aggressively tells investors, many of whom are very trusting senior citizens who look to them as having nothing but integrity and being the smartest people ever to live. And that entity encourages investors to stay fully invested in the stock market through a whole cycle. It's going to work well. But what are they doing with their own wealth? They have raised record cash. They've sold stocks because they don't like the valuations of the stock market and where they see it going in the future. So what does that tell you, right? So we have those data points that just came out. Second data point in the last 24 hours, we had the nation of France, historically one of our greatest allies, right? I told you about the UAE saying we're walking away from America and we're siding with Russia as part of the BRIC alliance. BRIC, for those who don't know, Brazil, Russia, India, and China. They formed an alliance, a non-US alliance for their members, for their nations, that they felt would be more prosperous for those nations. They didn't want to just be whipped around by the US on our policies. And that alliance has been growing. Now, Americans have been oblivious to the growth of this non-US, anti-US alliance. And they've largely been oblivious because so far, it's always been emerging nations that are joining. But today, Over 80% of the world's population is trading non-dollar. 80%, down from just a small fraction years ago. What does that tell you about the future of the dollar? Then what came out today was one of the nations that has historically been our closest allies, France, has filed an application to enter the BRICS summit. Doesn't mean they're necessarily going to join, but it's a step in that direction. France is saying the US is devastating our future with the policies they're enacting. We need to protect ourselves. We need to go with a non-dollar alliance. Think about that. When that hits the news and people understand that, when Germany is pressured to walk away because they need energy, and if they don't align with Russia, they're not going to get it. When these nations start coming out, walking away from the US, what do you think is going to happen to the dollar value then? Don't you want to have this allocation ahead of that kind of a shift? And the third thing that happened again today, just today, the Republicans in North Carolina stated all of our savings should be in gold. Think about that. Republicans in North Carolina stated all of our savings should be in gold because they're saying the data suggests the dollar is going to be crushed. So again, I'm not saying sell everything, but what I really hope you're coming away with is how can it be that all these professional financial advisors recommend 0% physical gold allocation to their clients? It is just incredulous that they can be acting in their clients' best interests if they're aware of this history and still going down that path. I submit to you, the only wrong allocation is 0%. The amount of gold you want depends on your concerns with the dollar and our debts. As a starting point, we suggest 20% of one's wealth is best suited in gold. And now I'm going to delve into the details and the history and the data, showing you some support for that. So I believe you can all see the our presentation. Is that right? Maybe can I see a hand if you guys see the preview?
We can see it here in person.
Okay, thank you so much. All right, so this first slide, why haven't you bought physical gold for my account? This was a question that we encouraged everyone to pose to their financial advisors. In the top half, this shows what's called correlations. And we didn't cherry pick 2 or 3 years. We went back to 1972, which was the first year gold began freely trading. Up to 71, gold was fixed price, right? So there really wasn't anything to measure in terms of correlations. Since then, it's been freely trading. Now, a correlation, for those who don't know, is what is the likelihood that two assets are going to move in tandem in price, or that they're going to move in opposite directions, right? So stocks, bonds, and real estate historically are correlated. When one of those three does well, they all tend to do well. And conversely, when one of them does really poorly, they tend to do poorly. So if you think about it, I mean, you don't have to be a rocket scientist to understand when you construct your portfolio and you have in your portfolio your home, your businesses, if you're an entrepreneur, right? You have all these assets. Doesn't it make sense that you want something in your portfolio that is uncorrelated, that thrives when your other assets are historically under stress? And what we see here is gold for this whole 51-year period has been inversely correlated to large cap stocks, inversely correlated to bonds. That means when they do poorly, gold tends to do well. That should be job number one of portfolio construction. Make sure you have some assets that do well when others do not. So then the bottom half of this screen shows the returns of these asset classes since gold began trading freely. So you see the arithmetic average and the CAGR, which is a compound annual growth rate, take your pick. The average return for gold over 51 years has been 10.3%. That is pretty remarkable for an asset that carries no liabilities and has never defaulted. In contrast, stocks, which have liabilities, which can go out of business, but which we own because of the excess potential return that they offer, has returned, including dividends, a little under 12%. So really you're picking up 1.5% by allocating to stocks, which are much riskier than gold. Again, I'm not saying go sell all of your stocks, but just think about these returns, the risks. And this is over 51 years when our debts were much smaller and valuations were a lot cheaper for these other assets. Similarly, bonds, 8.82% over the 50 years. But remember with the bond, even if you have a US government bond, the bonds carry guarantees. Gold has no guarantees. I cannot look you or your family in the eye and promise you that you're going to make gold. You're going to make money with gold. What I can tell you is that although gold doesn't have any guarantees, it has this precedent that's worth considering, this data. Bonds, though, think about it. An entity guarantees you that they're going to pay you back your principal and interest. But in the case of dollars, they're paying you back in an asset that is withering in value. So you'll get all those dollars back that were promised to you. But does it really do you a lot of good if the purchasing power of those dollars has been bludgeoned? That's what bond investors need to think about. Think about that too for life insurance. How many people bought life insurance policies for $10 million 20 years ago, and you thought, wow, that is so much money. That is so much money. There's nothing more my family could want. But in those last 20 years, the value, even in 20 years, is probably down 50%. And what's going to happen in the future? So this is the number, these are the numbers for 50 years of how gold has returned. Now, what we've done here is, again, not trying to cherry pick a little amount of time. We have looked at how different portfolios would have performed over those 51 years. And we have a dozen different combinations here. And we start with the classic 60% stocks, 40% bonds, 0% gold. And you see here the arithmetic average, the CAGR, and then you see the Sharpe ratio. A Sharpe ratio is really saying, what is the return relative to the risk and the volatility? So really, people will look for the highest Sharpe ratio is being even more important than the actual return, because it's supposed to have a metric of how much risk was taken to get that return. And what you see is over 50 years, if you had allocated 20% of a portfolio to gold, you had the most efficient portfolio, the best Sharpe ratio of these dozens. Obviously, there's an infinite number you could choose, but you can see the numbers and how we're getting there. We're not trying to cherry pick anything. We're just looking across the spectrum. So a 20% gold portfolio had the best Sharpe ratio. And you see that the CAGR, if you had a 20% allocation to gold, also, meaning the average return, also was higher than if you had gone 60-40 stocks and bonds. So you diversified the portfolio, you diversified your counterparty risk, you diversified your correlations, and the returns actually improved. The 0% gold really makes sense in light of this data. Now, how about, let's think specifically how gold has performed in times of stress. Because again, right now we have rich valuations, which is not a plus for stocks, bonds, and real estate, big debts, global stress emerging, increasing backlash against the dollar, right? So there is a case to be made that there's going to be financial market stress ahead. Indeed, I would submit to you that the only reason we have not had massive stress is that the government has printed $10 trillion and bought financial assets with that money to artificially elevate stocks, bonds, and real estate, because they knew the markets were going to be very stressed if they didn't step in and artificially support them. So here we're looking at the peak to trough period during the great financial crisis. So in 2007, the stock market peaked in October. It bottomed in March of 2009. And I think you remember all that stress. That was when Lehman went bankrupt and a number of other high profile entities had to be bailed out as well. So what you see is that during that time of stress, while stocks lost 37%, bonds lost a minimal amount, gold traded 17% higher. 17% higher. So again, think about your portfolio and your construction. Your stocks, your bonds, your real estate are down, but your gold is up notably, offsetting it, complementing the portfolio construction well. Here's another period that some of you may remember, the Great Bear Market from 1972 to 1974. Again, the same idea, starting at the peak of the market in 72 before it started trading lower and looking at it as it was bottoming. And that during that period, large cap stocks were down 24%, bonds were down 4%, gold was up 51%. I can't guarantee you that's exactly how it's going to play out in the future. You see the numbers are different from stress period to stress period, but I think you're seeing the pattern that has been shown again, all the way going back to ancient Greece. When there's stress, gold thrives, and it has been a blessing to families to have some. And now here we're looking at the granddaddy of them all. Again, same idea. How has gold performed in times of stress? The Great Depression, beginning with the stock market peak in 29, through the maturation of the Depression in 1934, stocks were down 8%. Now, peak to trough, stocks were down much more than that, but the Depression hadn't ended and the government hadn't intervened. So we elongated and said, okay, let's just say you hung in there for the whole Depression. Stocks were still down 8%, gold was up 14, bonds were up 8. So in each of those cases, when there was intense stress, it benefited a portfolio to have some gold. Now, what about the notion that the dollar is the safest place for you to be with that portion of your portfolio that you want to have as a sleep well asset, sleep tight asset? This chart is showing the major currencies of the world over the last century. The dollar, the Deutsche Mark, the euro, the Japanese yen, and that gold line at the top at 100, saying, okay, if we start with comparing the currencies as being on equal purchasing power with gold, how the currencies fare. And you see every one of them, it's just a question of time, ends up essentially becoming worthless when you consider how much purchasing power they lose relative to gold. So here we have more detail on what we talked about. Currencies backed by nothing end up worth nothing. That's what our founders tried to protect us from. So why, other than for convenience, and the dollar has merit as convenience when you're going in the supermarket, but why would you want all of your wealth in an asset that has never worked when this is your safe money allocation? This is the inverse of that. So what if you had diversified some of your cash, not only in dollar cash, but you bought some gold, essentially gold cash, gold money? The inverse is purchasing power of the dollar is obliterated. And here you see the value of gold in US dollars going back to the founding of our country. You see that flat line early on? Kudos to our founders, how well the dollar preserved its wealth. And then you see the value of gold explode relative to dollars because we take the gold backing away from it. Now, a number of people have said to us, you know, that was a good idea, but I look at the gold chart and gold has risen significantly in the last 23 years. The generational low in gold happened in 2000, around $250 an ounce. And now you could say we're approximately at $2,000 an ounce. That's a big run. A couple things to think about. First, realize that because gold is money, Its proxy is the dollar or other currencies. When you look at the explosion in money supply, literally money supply, and I'm sure you've seen those charts, it looks like a hockey stick with the printing of money the government has done. You realize that on an apples to apples basis, considering the expansion of money supply, gold actually is very cheap, almost as cheap as it ever has been in modern history relative to the dollar now. People made this same argument a century ago. It is so fascinating how history rhymes. Exactly 100 years ago this year was the Weimar crisis. Some of you likely remember that well. I'm sure all of you remember the stories from school where we read prior to World War II. If you lived in Germany, there came a time where you had to take a wheelbarrow full of money to the store in order to buy a loaf of bread. That's how much money it took to pay for a loaf of bread. Well, before it got to that point, in 1922, when you considered the German equivalent of paper dollars, they called it the paper mark. The currency in Germany was marks. The paper mark relative to a gold mark, you could exchange it for gold, at one point was less than 10 to 1. As 1922 progressed, that ratio became a lot more unfavorable to people who were holding the paper marks, such that, as you see here, entered 1923. Again, think about this, 100 years ago exactly, when people were saying there's going to be a problem here in Germany, we can't afford these debts. Naysayers were saying, don't worry about it, there's nothing to worry about, everything will be fine. Naysayers are saying, look, gold's already risen to a couple thousand marks for a gold piece. Sound familiar? It's already risen to a couple thousand marks. It was just at 10 marks a few years ago. Now we're at a couple thousand. As 1923 progressed, the catalysts came to the surface. And by the end of 1923, you see that you were looking at 1 trillion marks to buy one gold piece, when the exchange ratio had been less than 10 to 1 not that long ago. So to say that the dollar, the gold's run is really fully mature at 2,000 an ounce, we don't see any support for such bearish arguments, because we can't find one case in history where once a country's currencies became overly indebted, they were ever able to recover their purchasing power. That's just been a one-way ticket throughout history in the other direction, with gold becoming of increasing value. Now, I mentioned earlier that there have been other case studies where there was a sole reserve currency. If I haven't said it before, sole reserve currency has occurred in history on these handful of occasions when one nation was so dominant that foreign nations decided that they are going to do trade, not in their own currencies, but will convert it into that sole reserve currency, a reserve currency that people could bank on as being safe. The first case, as you see, was Portugal, going back to the 15th century. We've had this handful of cases, most recently Britain in the 1800s. So Britain had been the manufacturing power, like America has been most recently, global leader. And so citizens would save their money in the British currency called the sterling or the pound, and they would go to their banks. So you had, let's say, $1 million sterling saved in the bank, and you're feeling really good. You have the sole reserve currency. But it didn't just happen overnight. There were plenty of signs, like we're experiencing today, that there was trouble, that Britain's superiority, that their financial strength, all kinds of metrics were deteriorating. The people who dug their head in the sand and just said, we're the sole reserve currency, it's going to be fine, were decimated. Because one day they went to the bank, they could take out their $1 million sterling and they were wealthy. When they lost that sole reserve currency, they went to the bank, they could still take out that $1 million sterling, but it didn't buy a fraction of what it had while they were the sole reserve currency. That is what has happened in each of these cases. So do you want to wait until that happens before you try and get out of an overallocation to the dollars? Again, we're seeing the most plugged in entities in the world voting with urgency. I want to get a gold allocation now. So this chart shows one other argument that we hear from a lot of financial advisors. It didn't come up here, but we thought we would just throw it in. This chart done by Bank of England, Bank of America contributed to it, shows rates and inflation going back to 3000 BC. That's not a misprint. Now, as you can see in the left part of the chart, there's a lot of gaps in here. There's really only a few data points. But when ancient manuscripts talk about interest rates that were charged for lending money, they use that as a data point in here. Okay, this is where the market was back then. And then obviously, as we get into the 18th century, we get more regular data. And what we see happening here is that there has never been a case where interest rates on a sole reserve currency went to 20% like ours did in the United States in 1980. Every other time rates hit that level, it blew up the balance sheets of the nations and their currencies ended up being obliterated. But in 1980, when Reagan came in, and Volcker said, we are going to stamp out inflation, the US balance sheet was pristine. Right? We were in great shape. And so we could afford to raise rates. It slowed the economy, but we didn't have a lot of debt as a nation. So we didn't have to worry about the interest payments increasing for us and burying us. So we took rates to 20%. And then what we saw happen has been the story of our careers, right? Our whole lifetime. This gray bar that you see on the right side begins in 1980 and goes through 2021, COVID. So that is really our whole working experience. And what you see is that rates and inflation were on a generational move lower from 20% down to less than 1%, where treasuries traded in 2021. What is the significance of that? Rates, inflation, because rates are supposed to be set off of inflation, right? So inflation is the most important single metric in economics when you need to go and value any asset. Why? This formula you see in gray up here is the formula for discounted valuation of assets such as stocks, real estate, or bonds. And so what you want to do to realize, what is the current value of an asset is essentially you add up all the cash flows that you're going to get from that asset over time. You make assumptions, obviously, right? The stock's earnings are going to grow at 10% a year forever, or whatever your assumptions are. But then you discount back to today the value of those cash flows, right? So $1 today is worth $1. But if I give you $1 in 5 years, it's not going to be worth a full dollar because it depreciates in value as a currency, right? The higher the inflation rate, the more value you lose in those assets. And so the lower multiple you would pay for an asset producing cash flow. Think about this. So in 1980, when interest rates and inflation were high, the S&P, the stock market, traded at 8 times earnings. 8 times earnings. Because as they look forward with inflation, it wasn't worth any more than that. And then what you see happen, if you go back and you look at the market, you had this expansion in multiples in the market as rates came down in this generational move. So the backdrop for our whole careers has been declining interest rates, declining inflation, expanding multiples for stocks, bonds, and real estate. So think about that. That is the ideal backdrop for financial assets, for paper assets. And in that backdrop, you really don't need as much gold, right? You have it for a risk insurance policy, but in terms of an allocation, you don't need it because you're benefiting from this expanding multiple afforded to all financial assets. All right, so what's happened? At the end of that period, guess what? People had massive overallocations to financial assets, right? Because they're expecting this performance to continue. Now, the question is, what are the next 20 years going to look like? Do you think rates and inflation are going to go to negative 15%? If you do, then you can expect that we're going to have further expansion in multiples and financial assets are going to do great. But by the way, look and see here, you never see rates going negative. They did in this cycle because the government shoved so much money into the system with such artificial purchases that it broke financial modeling. You actually had negative yields on bonds. What that means, imagine the audacity if I came to you and I said, I want to borrow $1,000, face value of most bonds. But you know what? You're going to pay me for the privilege of lending me money. That is essentially how broken valuations became with the government money printing during this current cycle. So it's not a high probability bet to think inflation is going to go negative territory, rates are going to go drastically into negative territory to bail out financial assets. What you see is that these are cyclical, and the deeper inflationary pressures have receded, you see the higher the inflationary spike. So what do you think is likely ahead if we're coming from the most expanded multiples and the most contracted inflation that we've seen in history? I think it could be a snapback. History again suggests the probability is usually positive that that's what's going to happen. When inflation rises, when interest rates rise, bad for stocks, bonds, and real estate, it's great for gold. How significant is that? Here's a chart, I should say a table. And again, it went back and looked at the 50-year period since gold began trading freely in the United States. And what we did was we took the top quintile of inflationary years, so the top 20% of years where inflation was the strongest. And we said again, all right, let's dissect this. And we added in here real estate, because real estate is obviously a real tangible asset. And we wanted to look at that because many people say, oh, real estate will do just as well as gold. That certainly was not the case. Why? Unless you're paying for real estate in cash, you're buying a mortgage, you're taking out a mortgage, and you are negatively impacted by higher rates because less people can afford that mortgage at a higher rate, right? It's a whole lot easier to afford $1 million property when rates are at 1% than when rates are at 20%. So here, we looked at, again, a bunch of different portfolio allocations. Remember, from 1971 up until the current day, 20% gold was an ideal allocation. But in times of inflation, which history suggests is what we're sailing into, the ideal allocation, as measured by the Sharpe ratio for efficiency of the portfolio, was a 40% allocation to gold. 40%. And if you just wanted to look at compounded annual growth rates for your portfolio, the ideal portfolio allocation was 70% gold. Mind you, when we did this, we said each of these four assets has to have at least 10%. So you have to have at least 10% stocks, at least 10% bonds, at least 10% real estate. And what kicked out was you wanted the max gold if you were shooting for return, and you still wanted 40% if you were shooting for portfolio efficiency. So to me, the takeaway is this: the data is clear. This isn't about opinion. This is about history and finance. When you have a backdrop like we have today, it makes huge total sense to have some gold as opposed to the average American allocation today, which is 0. And that's what we really just wanted to submit to you. I think there's urgency. I don't want you to have to go through the pain that I did, hoping everything would be okay when it was so easy to transition to something that would benefit from the backdrop of the day. Gold is a beneficiary of today's backdrop. That's why you see the most sophisticated investors moving into it. And I want to encourage you to pray about, for wisdom, to think about, and then to act on what you conclude is the most prudent course for your family. And I think you're going to conclude is to allocate a portion of your wealth into rock solid gold. The irony of the moment we are at today is that although we buy gold for defense, for wealth preservation, that's why we suggest to everyone they own gold. As you see here in these numbers, in times of inflation, gold also has significant upside. So it's ironic, the safest asset that no one has allocations to today, financial advisors tell their clients you don't want, is setting up potentially for some notable upside as well. So I hope that that has been helpful in addressing the one written comment we got back about why a financial advisor would say your clients, investors don't want gold. How about I'll pause there, and I welcome questions, feedback, objections from the audience.